Hello. Today I'm reviewing some charts for my portfolio that I found interesting at the close on January the 16th, 2026. I'll share with you what I'm seeing on these charts and how they help form any decisions that I make on these holdings. I will start out today with a brief overview of the market because I'm seeing a bit of a rotation and want to highlight that in some of these charts. If you enjoy videos like this, please subscribe to the channel to help support the channel. Be sure to set your notifications for future videos and also be sure to like the video to help support the channel. Let's get started. We'll start off with a quick look of the major indices from last week. We can see that the semiconductor index actually outperformed with 3.75% rise last week. That was followed by small caps, mid caps. And the S&P 500 equal weighted index actually outperformed the S&P 500 cap weighted index by about a full percent. The Dow Jones Transportation Average was up about 1/3%. The Dow Jones Industrial Average, the S&P 500 cap weighted index, and the high growth NASDAQ 100 were all in the red for last week. So semiconductor was a bit surprising. TSM did report this past week with good numbers, so I'm sure that helped the index. But the overall growth index, the NASDAQ 100, was at the bottom of the pack last week. This is the performance of the sectors, and we're looking at a full week, so that would be closing on Friday. We see an interesting trend here where more defensive came into play over some of the more offensive sectors. So real estate was at the top of the performance list with a bit over a 4% increase for the week. That was followed by consumer staples, another defensive area. The industrial group is more of an aggressive area, but it was up about 3%. It was followed by the energy sector at a little over 2%. Utilities is also defensive, and that was up 2%, followed by materials at just shy of 1% increase for last week. Then we see that the S&P 500 itself was down about 1/3%, followed by technology being down just about the same amount. Healthcare, which is a mixture of both aggressive areas and defensive areas, was also down 1%. And we have the consumer discretionary, which is aggressive, financial, which is aggressive, and communication services was at the bottom of the sector performance list. We did have the major banks report this past week, and the financial sector overall was down 2.31%. The S&P 500 did manage to close at a record high on January the 12th. That is currently trading above an upward sloping 20-day moving average, 50-day moving average, and we have an upward sloping 200-day moving average. We do have major support at about 6,500. I do notice that the put call ratio is starting to flatten out after being on an increase on a 5-day moving average. These gray lines in the background is the raw data. So we reached a high back on the 14th of January, and it's currently sitting at a pretty low level, so people don't seem to fear that, or at least they're not expressing any fear related to a downturn. Typically, when the puts go up, you're either already on a downturn or you have reached the actual bottom of a correction. So people seem to be pretty complacent, buying puts at this particular time. If you think that we have any possibility of a downturn in the future, this is one of the better times to buy some puts, as those puts tend to be less expensive when the volatility is down. When we look at the VIX, or the volatility index, we reached a low on December the 24th during the holiday period. That was pretty much with light trading. We are seeing a general overall increase in the VIX. This past week we did actually drop back down to about 15.86. It hasn't yet crossed above 17, where I have this gold line, just as an indicator that volatility is beginning to increase and needs to be watched pretty closely. And then you can see this line at the 20 level. When it gets above that, then you have pretty significant volatility and fear in the market. So we can see that we reached our peak for this 1 year time frame back on the 8th of April, and that was after the tariff announcements, but that pretty much signaled the bottom, which I think occurred on the 7th, and then the S&P recovered pretty quickly after that fear subsided in the market. This is a chart that looks at the SPX, and then it compares the XLY, which is the consumer discretionary sector, compared to the XLP, which is the staples sector. It compares the performance of those two in relation to one another. Then we have a correlation that compares the performance of the S&P 500 and that particular ratio. And then we have the two sectors graphed independently. But what we can see, because discretionary is when people buy the stuff that they want, compared to staples, which is stuff that they need, we can see that when the ratio of the XLP to the XLY to the XLP is trending downward, that you tend to have a decrease in the S&P 500 as well. And the correlation on that is pretty high. You can see the correlation here on this particular panel in this chart. And then we can see that the XLY did decrease in the 2022 time frame, and the XLP pretty much stayed flat for the entire year while the markets were declining. And then at the end of 2023 through the middle of 2024, we saw that the ratio was pretty flat, comparing XLY and XLP in their relative performance. The S&P 500 did increase. The correlation on that is pretty high, and both of these sectors were contributing to the overall performance of the S&P. Then at the beginning of 2025, we saw a decrease in the S&P 500, and the relative performance of the XLY compared to the XLP was on a pretty steep decrease for about 4 or 5 months. We can see that the XLY performed negatively while the consumer staples group performed well. But when you have the XLY going down, the XLP increase was not enough to overcome or keep this relative strength flat, so we ended up with a downward trending S&P 500. And then for the remainder of the year, we did see the increase in the SPY. We saw the relative performance of the XLY, the discretionary group, compared to the XLP was on an upward slope. Correlation was high. XLY performed well, while Staples underperformed, but the XLY was able to carry the S&P 500. And then we're starting to see this relative performance comparing these two sectors decreased during the end of October through November, picked up a bit of steam, but is now turning back down. So XLY is underperforming the S&P 500. We can see that the S&P is still moving higher, but the correlation is starting to go into negative territory. So we have the XLY decreasing. What is able to carry this S&P 500 higher despite this slight decrease is the overall performance in the consumer staples. So they were very strong this past week and able to carry the S&P 500. Unfortunately, consumer staples alone are rarely able to carry the S&P higher. You really need that discretionary spending. You need those companies in that particular sector performing well, or the overall tendency is for the S&P 500 to go down. So we did see the XLY perform, somewhat during 2023 and 24. The Staples really performed well and was able to drive that higher. But you can see here that if the Staples are staying flat and the XLY is going down, you tend to have a decreasing S&P 500. So I'm keeping a close eye on this. I'm a bit concerned that we're still seeing an increase in the S&P 500 when we're seeing an overall decrease in the relative performance of the discretionary group. Then we'll look at one more series of charts, and this is related to offensive versus defensive. So one of the things we'll notice, this is a comparison of the QQQ versus the S&P 500. So the QQQ is predominantly growth. The S&P 500 also is growth, but it has a component of defensive companies in that particular index. One of the things we see is we're seeing still a slight increase to sideways movement on the S&P 500. But when we look at growth versus a sector with less growth, we see that the relative performance of the QQQ compared to the SPY is actually negative. When we look at the same for discretionary versus staples, we are also seeing a slight decrease. When we look at large cap growth compared to large cap value, that actually started back in August, where the growth was performing less well than the value. We did see it peak back up at the end of October, but is still on a decline. Then when we look at mid-cap growth compared to mid-cap value, we also see a decline in the relative strength of growth over value. And then when we look at small cap growth compared to small cap value, that has been pretty much flat over the last couple of months. We did have a decrease back in October to the beginning of November, but has been relatively flat. So the relative strength of the growth components over value components is definitely decreasing, and has been doing so since about the end of October. So that's a bit concerning and something that I'm watching very closely. So my basic observation has been a rotation toward more defensive areas of the market. I want to highlight the XLP, the consumer staples, which we can see that the accumulation has been pretty much flat or in distribution. But let's look at this significant rise in the XLP for accumulation is at a 52-week high at the moment. And look at this, significant rise over the past few trading days to all-time highs as well. Then another very defensive group is real estate. Real estate had been pretty much in the same condition, trending downward on the distribution, but we're seeing a nice accumulation, not back quite to 52-week highs, but definitely making progress. Money flow is positive, and we see this increase in the real estate sector over the past few days. If we look at 5 years for the real estate, we can see that they peaked out at the end of 2021. Then we had the interest rate hikes from the FOMC when it reached its low of about 29 in 2023. Has since been on an increase with the rate cuts that we are currently seeing. We pretty much traded sideways for the last year or so, but we are starting to see this push higher and not far from all-time highs on the real estate sector. For my individual holdings, I want to start off with ABBV, which is in the healthcare sector, biotechnology industry. And I bring this one up because AbbVie had moved to an all-time high back on October the 1st, and they've been in a slight decline, but they are getting close to really good support that was established back in March and was tested here in September, tested again in November, and it held as support, and they are getting back down to that support area. I had recently picked up a few shares and then sold them as the prices were higher, so I'm slightly underweight in my portfolio, but it's looking like it's getting to a really good price to bring that back to an equal weight in my portfolio. I do have this upward trend line that's been tested 2 times. They did break down below that trend line, so I think that they'll probably bounce off of support here and move back into a positive trend. I have a blended intrinsic value on AbbVie of $253.54. They do pay a dividend of 3.23%. They have a 5-year dividend growth rate of 6.65%. There are 19 analysts that cover AbbVie with an average 1-year price target of $239.16. with a range from 190 to 289. When we look at the seasonality for AbbVie over 13 years, we can see that January is the weakest month over this time period. They end the month down about 1%. they only are higher at the end of the month than at the beginning of the month 38% of the time. So this is their worst performing month from a seasonality perspective. June would be next, where they fail to close the month higher. But for the remainder of the months, they do close the month higher over 50% of the time. So ABBVie has been a really good holding for me. They're seasonally weak this particular month. They're coming down to a good support level, so it looks like a pretty good time to be adding some shares. They've done a really good job of holding an RSI of 40. I see in the beginning of November that they did drop below 40. During the tariff announcements, they dropped below 40, but most of the time they stay above that RSI of 40. They did peak out on the RSI at the all-time high on October the 1st. So they are showing they're at the bottom end of the RSI, which corresponds to the price, and I think it's looking like a good time to pick those shares up. We do have a sell signal on the PPO. When we look at them in the weekly chart, we can see that they have an RSI of right around 50, just shy of 50. They've also been in a sell condition since the 27th of October. We'll see if we get through January, which is their weakest month, and see if they can return back to a price oscillator that's in upward moving territory. The money flow is positive. We look at them in fast graphs, we can see that they have a blended PE of 19.87 times. They have an EPS yield of 5.03%. They do have that dividend yield of 3.23%. Over this 13-year time frame, they've had an adjusted operating earnings growth rate of 11.41%. Fastgraphs has their fair value calculated at 15 times, and the normal market multiple is 13.31 times, which is the blue line. The fair value is the orange line. We can see for most of the time they tend to trade below their typical market multiple. They did cross above that in 2023, and then they crossed above their fair value in January of 2024 and have been trading above their fair value since that time. We had a couple years of earnings contraction here. It moved back up and expected to be 5% for the close of 2025. Next year, they're expected to grow pretty significantly by 34%, 11% for the following year, and 10% in 2028. So they're priced a little over their fair value, but even if they traded sideways, they would be back to fair value by the end of 2026. I have held ABBVie since December of 2020. All of these that are shaded in green are shares that I've sold. The ones that are still in white are current holdings that are still open. This is one I've traded pretty heavily. They're pretty cyclical. The price moves up and down, so it's been a good trading candidate. So I bought a total of 1,223 shares. I currently hold 165. This is one that's actually returned all of the capital, so my adjusted net investment is in the negative. So this has returned all the capital to me. My current investment I have at an average cost of $140.38. They've had a capital appreciation of 25%. They paid out dividends of 4.6%. I have traded some options and picked up another 0.1% on this one. So my current return is 85.3% or 29.6% annualized. I've made a total of 52 trades. 50 are winning trades, 2 are losing trades. My total gain's been $48,000 or 966.53 for each trade on average. My losses have only been $117.89 for the 2 losing trades, or per trade would be 58.94. So that gives me a win rate of 96% and a gain-loss ratio of 16.4 to 1. When we looked at Amazon last week, they were on an increase, but this week they pretty much given back what they increased last week. We do have a resistance point at around 250 and one above that at around 260. They are currently trading below a declining 5-day moving average. They did close above an upward sloping 21-day moving average, but the 50-day has also started to decline. The 200-day is still increasing, so they're in a primary uptrend. I do have support levels at $205 and $201. Amazon has a portfolio ranking of 21 in my portfolio. I have a blended intrinsic value on them of $238.97. There are 45 analysts that cover Amazon with a 1-year price target of $235.38 with a range from $195 to $340. They do have an RSI that is above 50, so it's still in bullish territory. We do have a PPO that is declining and looks to possibly be crossing below the signal line. That would indicate a sell signal, but it's still positive at the moment. If we look at them on a weekly basis, they did decline 3.34% last week. The RSI made it up to 60, but is currently declining, but remaining in positive territory above 50. And on the weekly view, they are on a buy signal with the moving average above the signal line. Money flow in the weekly view is currently negative. If we look at Amazon in fast graphs, they are trading below their fair market value, which fast graphs has them calculated at 50.31 times. They've had an operating earnings growth rate of over 50% for this 13-year time frame. We've been watching Ares Capital, symbol ARCC, over the past few weeks. They had been on a decline over credit concerns. They got down below their book value, which is sitting at $20 per share right now. There are 10 analysts that cover ARCC with a 1-year price target of $22.50 with a range between $21 and $24. They did hit a 65-day swing high on the 14th of January, and that was followed by another 65-day swing high on the 15th. They have managed to move above these downward trend lines, and I see a resistance level just above its current price at about $21.14 is where that resistance currently sits. They do have an RSI that is above 60. The PPO is in a buy configuration at the moment. When we look at them on the weekly price chart, we can also see they're above the 50 line on the RSI, and they have been in a buy configuration since the 24th of November. It looks like the accumulation is nearing 52-week highs. On the weekly view, the money flow is currently in a neutral condition to slightly negative. Citigroup reported this past week. They have a portfolio rank of 31 in my portfolio. That is up from 36 last week because I did make a couple of purchases this past week. Citi continues to have one of the lowest price-to-book ratios of the 5 U.S. diversified banks, with a price-to-book of 1.07 per share, compared to the average of the 5 major banks of 1.74, which would indicate about a 62% upside on that particular metric. There are 14 analysts that cover Citi with an average price target of 123. That is up following their earnings on raised analyst earnings estimates. And they have a range between $77 and $150. I have a stop loss on them currently sitting at $116.69, which is the same as last week. Citigroup does have their investor day scheduled for Thursday, May 7th of this year. I see resistance on Citi at about $123. I see support at 112, which it did come down and test after their earnings, but quickly recovered throughout the day, and the following day was up 4.5%. I bought shares on Monday, and then I bought another 10 shares after their earnings at 111, which is at the bottom of that day. I have a price target on Citi of $160 to $185 by the end of the year. If we look at the major banks, they all reported this past week. Bank of New York Mellon was the best performer over the week with a price change of 1.92%, followed by Citi, which was down 2.7%. But JP Morgan, Bank of America, and Wells Fargo all fared worse throughout the week. Some of this was also in relation to President Trump proposing that they cap credit card limits at 10% for a year. So that drove all of the banks a little bit lower. But I was pleased to see that Citi was able to minimize their price loss at just 2.7%. They are continuing to trade above their 50-day moving average and an upward sloping 200-day moving average. Their RSI did drop below 50 on the day of their earnings, but it has moved back into positive territory. We are on a sell signal as of the 8th of January in the daily view. If we move to the weekly view, we can see that they are in an overbought condition. They're still in a buy configuration since the 1st of December in the weekly view, and money flow is positive. If we look at Citigroup in fast graphs, we can see that they have moved above fair value, which is the orange line. They have a fair value ratio of 15 times. In fast graphs, their normal PE is 10.85 times, which is the blue line. They had been trading below their fair value for quite a few years because they were an underperforming bank. They did begin a turnaround with a new CEO in 2021. They've completed most of their transformation, and once that transformation looks like it was going to be successful, they really started moving up in price, and I have high hopes for Citigroup for this year. Last week I had shared with you that I had executed a put vertical before the earnings to take advantage of the volatility crush. I did have that put expire worthless, so I had a profit on that of $154.48. To minimize my risk, I had bought a 110 put for $48. I closed that after their earnings for $18, so I did have a loss on that one, which I expected. But my total profit on that vertical put was $123.45. So the return on risk was 27%. Transaction analysis for Citigroup, you can see I've held them since July of this past year, 2025. I have currently 60 shares. Capital gain is 12.1%. I have 1% from dividends received, and the option trading has added another 1.73%. So my current return is 17% overall, 67.6% annualized. I've had a total of 10 trades. 9 of them are winning. 1 is a losing trade. That gives me a win rate of 90% and a gain to loss ratio of 4.75 to 1. This is Centene, symbol CNC. And this one has been pretty rough over this past year. Back in July, they did withdraw their guidance, and that sent the shares down about 40%. UNC, pretty much about the same time, did exactly the same, and UNC dropped pretty significantly. One of the things that I notice on CNC is from this low back up to where they're currently trading, they are up about 89% since that August 7th low, and that's compared with UNH, which is only up 44% since their August 1st low. This one has a portfolio ranking of 27 in my portfolio. I have this cyan colored line at their blended intrinsic value, which is $42.33. So they are currently trading above what I consider fair value for CNC. There are 16 analysts that cover Centene with a 1-year price target of $41.19 and a range between $28 and 81 cents. We had some downward trending lines here to monitor their progress. They finally did break above the lowest of the trending lines on about the 5th of November. They broke above the next level on about the 11th of December. They did move above a downward sloping 200-day moving average on about the 5th of January. They've moved up and have since leveled off, and they're sitting right at this downtrend line that I have sitting here. They are trading above a upward sloping 50-day moving average, and the 5-day moving average looks like it could begin to roll over here shortly. They are trading above a 21-day exponential moving average as well that is upward sloping. They did get into overbought territory on the RSI in the daily view. They have moved out of overbought, currently sitting at 64. We do have a buy signal on them as far as the PPO beginning on January the 5th. That looks to be closing, and if they have negative prices or sideways movement, then that'll probably move into a buy signal. So I'm considering covered calls on this particular holding. If we move to the weekly view for Centene, we can see that they have been in a buy signal since the 8th of September. They come out of an oversold condition, and they've been driving the RSI up week over week. We're currently sitting at about 60, which we look at the time frame in July. They were sitting right at 60 before they made their announcement to withdraw their guidance. Costco has a portfolio rank of 20 for my portfolio. That is down one position from last week due to me selling one share this past week on this recovery. I have a blended intrinsic value for Costco of $616. There are 21 analysts that cover Costco with an average price target of $1,056 and a range between $769 to $1,225. Costco had been on a pretty significant downtrend since they peaked out in February of 2025, but they have made a very nice recovery over the past, since the beginning of the year. I had bought and sold some shares as we went along. They did reach a 52-week low on December the 19th, but if you look at this huge amount of volume, I in that video for January or December the 19th, I did an analysis on when sell volume had reached this level, and based on my research and analysis, I expected that that was going to be the bottom for the Costco sell-off. It did sell off for one additional day, but since then has recovered quite nicely. It has closed above a 200-day that had been decreasing but is now leveling off. The 21-day crossed above the 50-day moving average and is increasing, and the 50-day has also stopped decreasing and is now on the rise. We do have resistance sitting here at about 997, and based on my analysis of the price action, I think we will probably reach that level sooner than later. Costco closed 4 out of 5 days this week higher, crossing above that 200-day moving average on Wednesday. That set a 65-day swing high, and it did that on both Thursday and Friday. The RSI finally did manage to break above 60 on the 8th of January, and that's the first time that it has been above 60 since August the 20th of last year. We are in a buy signal on the PPO that started on January the 5th. If we look at the weekly view, we can see the RSI is above 50, approaching 60. They were up 4.19% last week, and that represents a 13-week swing high. So they set 65-day swing highs and a 13-week swing high this past week. Next, we'll look at CorMedix, symbol CRMD, in the 1-year daily price chart. This has been a little challenging. On the 8th of January, they did issue lower than expected full year 2026 guidance, and that caused a pretty significant drop on that particular day, down 32.77%. I still have pretty good hopes for this company. I did put out a detailed video on this holding on the 30th of November on why I believe this one could do well. So far it isn't, but we'll see how my view changes. They do have an analyst day planned for February the 10th, and the big question to answer out of that is, can management prove that the patient growth is strong enough to overcome the TDAPA reimbursement hurdles that they're currently facing? So if they can overcome that particular challenge, then we might see a recovery in pricing, but that will be a key day to be watching for in the near future. I have a price target on them of $14. The blended value on them is $25.07. There are 7 analysts that cover CorMedix with an average price target of $17.29 and a range between $12 and $22. And one of the things that I find fascinating is, since they made this announcement on the 8th of January, that the analysts haven't really adjusted their 1-year price target. So I noticed on CITI that they adjusted them pretty rapidly upward. But CorMedix, they've announced this lower guidance, and yet analysts have not yet really decreased their price targets. So I have some hope that maybe those price targets are still in play. So we can see that they are on a downtrend, a short-term downtrend. The 200-day is actually had flattened out, but is now increasing ever so slightly. They have a 50-day that is trending downward. They have a 21-day that is also trending downward. I have price support at 677, and that was added since I showed this chart last week, because I did find this additional support here, and it is trading right at that level at the moment, so I'm hoping it can hold this level. We'll just have to keep watching this over the coming days to see if it can find support there. If it does break down through that, then the next level of support that I see would be at the tariff announcement lows of about $5.65. So I've been buying some shares, and I had also been selling some puts. One put I was actually assigned, so I picked up 200 shares at a cost of $8.46. That was on a $9 strike price. So the premium that I received did discount my actual price down to $8.46. And I also, on the 14th, so Wednesday of last week, I did sell one additional put with a strike price of $7, and I received a premium of $50 on that particular sell. CorMedix did hit a 65-day swing low on the 16th. The share price was down 3.28%. And if we switch to the weekly chart, we can see that they were down 11.14%. And that was also a 13-week swing low. This is a relatively new company. They IPO'd in September. I rarely get involved in IPOs, but this one I could hardly resist. This is FIGR Technology Solutions. They do blockchain consumer finance based on the blockchain. I bought my first shares, about 30, at $55.76 on January the 6th. They are up pretty significantly since that time, about 33% over the last 2 weeks. They are trading above an upward sloping 5-day, 21-day, and 50-day moving average. We don't have a 200-day on this one. They did break through resistance, which is now support. That line was at about 58. I have a stop loss set on them of about $63 at the moment. I did sell a put with a strike price of $50 for $52 on the 13th. I bought that back on the 16th for 3 cents. So that was a profit of $47.97, 94% profit, 11,500% profit annualized. And then I sold another put with a $50 strike price on the 16th, expiring the 20th of February, and I was able to sell that for 95 cents per share, and contract covers 100 shares, so that was $95 in premium that I received. So I'm trying to drive my net cost down, as this one seems to be moving higher. They do have an RSI that is in overbought territory. They've been on a buy configuration since the 2nd of January, and I bought in on the 6th of January. And I plan to do a detailed video on this particular holding and why I am interested in holding this one despite it being an IPO. If we look at the weekly chart, we can see that they were up 27.26% this past week. This is Genmab. They're a healthcare company out of the Netherlands. And I closed out my holding on them on the 31st of December. And that was basically because the first quarter of the year tends to be a seasonally weak period for Genmab. And after I sold that, it looks like possibly I had made the wrong decision because it continued to drive higher. But we did have a price decline of 5.87% this past week. And that was despite announcing that they had a specific bispecific antibody that they market as EPKINLY, and that's in partnership with ABBVie, that it did extend patient survival without tumor progression in late-stage trial for B-cell lymphoma. So I considered that good news, but they did have a sell-off, which I found quite interesting. So I'm going to continue to watch this one through the first quarter, and if the seasonality plays out and they get back to prices that I find reasonable, I will step back into this one. The 21-day did roll over this week, so it is declining now after the steep decline on the 16th. The 50-day is still moving higher, and the 200-day is moving higher. The RSI did move below the 50 line, so it is in bearish territory at the moment. And we did finally get a sell signal in the daily view. Next, we'll take a look at Alphabet, symbol GOOG, which has performed incredibly well and probably has one of the best looking charts of the megatech companies. I have a blended value on them of $319. There are 43 analysts that cover Alphabet with an average price target of $320.35 and a range between $190 and $400. They did reach a peak on about the 25th of November, did have a slight sell-off, but have since recovered back to all-time highs this past week and having a little bit of sell-off towards the end of the week. But they do have a very strong 50-day moving average, a 200-day moving average that's moving higher. The 21-day is also moving higher. The one thing, or a couple of things that are still concerning me about Google in this recent run is they continue to be trading above their 200-day moving average by quite a margin. It's currently 45.47%. That did decrease slightly from last week where it was 47.77%. They're also trading 6.57% above their 50-day. I do have a stop loss on them of $318.50, and that was raised from the prior week of $308.64. So they're still looking very strong. They still have a bearish negative divergence. That's basically where the prices are going higher, but the RSI is not reaching higher levels, so that's still in play, and that also exists on the PPO. So their RSI, they've been able to hold pretty much above 40 ever since the tariff announcement lows, so they do have a very strong chart. If we look at the weekly, we can see that they were able to close the week up 0.36% last week, despite the sell-off in some other tech names. This is Meta Platforms, symbol META. They had a pretty good sell-off back at the end of October. Basically, after their earnings, they had a pretty high capital spend on their AI expenditures, and the market was pretty much displeased with that and sent them down about 11% on that day. They continued to fall but did increase, and they actually formed a cup with handle. And on the 19th, based on that cup with handle pattern, I had a target price of 733. That one is obviously failing as they've been breaking down over the next couple of weeks. During this time, I had been buying calls on them and performing very well because they tended to spike up about every few days above their 200 days. So I could sell those calls and make a little bit of premium on those, but that started failing as well, where instead of having spikes to the upside, they had spikes to the downside, and then finally they started selling off. So they're trading below a 200-day moving average, a 50-day moving average, and a downsloping 21-day moving average. I have a support line here at about 605. We'll see if they can hold that. If they don't, I have additional support levels down here between 535 and 516. So I'll remove this note here because that pattern, cup with handle pattern, actually failed as we review them next week. Their RSI has dropped below 40. That's a little bit of a disappointing sign, and they were not able to recover above that 40 by the end of the week. They are on a sell signal on the daily price chart. If we look at the weekly price chart, it looks like it's somewhat neutral, neither a buy nor a sell at the moment. And they are still above 40 on the weekly chart. This is Hershey in the consumer staples sector. Hershey's chocolate, and I included this one because of this sharp rise we've seen over this past week, showing that rotation into some of the consumer staples. I have a blended value on them of about $190. There are 18 analysts that cover Hershey with the 1-year price target of 187, with a range between $134 and $222. They do have a yield of 2.77% and a 5-year dividend growth rate of 11.68. If we look at them on a weekly chart, we can see that they were up 4.6% this week. On the weekly chart, they do have an RSI that just crossed above 60, and we do have a buy signal on them. If we look at Hershey and fast graphs, we can see that they're trading above their normal market multiple and trading above fair value. This is Johnson & Johnson, symbol J&J. They do report this Wednesday, January the 21st, and I did provide a video on them providing an earnings preview. I have a blended intrinsic value on J&J of $172, so they're trading well above what I consider fair value. There are 15 analysts that cover J&J with an average price target of $209.27, with a range between $153 and $240. The seasonal performance for J&J during the first half of the year is somewhat neutral, so I am continuing to sell covered calls. I believe that's reasonable. They do have a forward yield of 2.38% and a 5-year dividend growth rate of 5.25%. I do have a stop loss on them of $214.90. They do have an RSI that was in overbought territory, but it has dropped below that level. They had done a good job of their RSI. It had come down and found support at 40 and then broke out above a previous high, went into overbought territory, came back down to that support level once again in overbought territory. But this created a bearish negative divergence, so we have higher prices with lower RSI, and it looks like this last run higher is also going to be on lower RSI. That gives me additional confidence in selling the cover calls. I do have one that I bought or sold on the 6th of January. It expires this Friday. I was able to sell that for $121. That's currently a losing trade, but I feel that we're going to have a sell the news event after their earnings, and we will find lower prices. They had broke out above this resistance level, so that's now a support level that I'll be watching here over the next few days. If we look at them in the weekly view, they are still in overbought territory, and we did get a buy signal on Friday. I think that will be reversing after they share their earnings this week. This is Jackson Financial, symbol JXN. This is a relatively new company, just having IPO'd about 5 years ago. I don't think they're truly appreciated by the market. They've had a really nice run since the middle of November, reaching all-time highs, but they did have a bit of a sell-off this week. They are still trading above an upward sloping 21-day, 50-day, and 200-day moving average. I have a blended intrinsic value on them of $306.30. Their current book value per share is $141.89. There are 5 analysts that cover Jackson with an average 1-year price target of $108.80 and a range between $95 and $128. I have a stop loss on them at $110.44, which is the same as last week. They were in overbought territory on the RSI. They have moved out of that position, still in a bullish RSI. We did get a sell signal this week in the daily view. If we look at the weekly view, we can see they were down 3.25% this week. They were in overbought territory on the RSI. They have moved out of that condition. And on the weekly view, they're still in a buy configuration on the PPO since the 8th of December. I added a few REITs to the review this week because they've been showing some really good price action as the market seems to be moving a little bit more defensively at the moment. I have a resistance level on NNN at $42.96. I have support levels at about $39. They are trading above somewhat flat 200-day. The 21-day looks like if this price action continues, that it'll cross above the 200-day. It already crossed above the 50-day on about the 13th of January, and the 50-day is also upward sloping at the moment. The RSI has gone from below 50 up to an overbought condition. We haven't really been above 60 RSI since the 11th of July. The PPO is indicating a buy signal on this REIT, and it looks like the delta between the moving average and the signal line continues to get stronger. If we look at this one on more of a 5-year time frame, we can see that they had highs back in 2023 of about $40. They did move higher on interest rate cuts last year, getting up to about $46. They did sell off, somewhat stabilized, and are now making their way back higher. If this defensive transition continues, it would not surprise me for them to be back above this $46 price. NNN has a portfolio rank of 12 in my portfolio. I've owned them since September of 2021. There are 6 analysts that cover NNN with a 1-year price target of $43.17 and a range between $43 and $44. They do pay a dividend of 5.63%, and they have a 5-year dividend growth rate of 2.66%. If we look at them on the weekly chart, we can see that they were up 3.9% for the week, and that does represent a 13-week swing high. If we look at NNN REIT in fast graphs, we can see that they are trading well below their fair value and their normal market multiple. This is Realty Income, symbol O, in a 1-year daily price chart. Once again, we can also see this significant rise over the last few weeks from around their 200-day moving average to near all-time highs. They do have a trend line that they've been riding above as far as prices. It broke down on the 30th of October, and it took until the 14th of January for us to break back above that trend line. One of the interesting things about REITs is you usually see them increase in price when the 10-year Treasury decreases. But what we're seeing here is the prices going up while also the 10-year is moving higher. So this tells me that it's not so much about maybe rate cuts coming as it is simply a move toward more defensive stocks in a downturn or a perceived downturn. So I think investors are actually looking for some safety at the moment. They are in overbought territory. We've been on a buy signal since the 2nd of January. This one is the largest position in my portfolio. I've held it since July of 2022. There are 12 analysts that cover Realty Income with a 1-year price target of $62.58 and a range between 60 and 68. On January the 16th, they actually hit their highest weekly adjusted share price since August of 2022, following the 4th of 11 FOMC rate hikes that started in March of 2022. And it's the 5th reduction since we began rate reductions in September of 2024. This one pays a dividend of 5.28%, and they have a 5-year dividend growth rate of 3.51%. If we look at them in the weekly view, they have not reached an overbought state in the RSI on the weekly view, and we do have a buy signal on the weekly time frame. Money flows are positive. If we look at them in fast graphs, we can see that they're trading below their fair value according to fast graphs and their normal market multiple, which they really haven't traded at these levels since the rate hikes started in 2022. This is Prudential, symbol PRU. We can see it. They had a pretty big sell-off on January the 16th, Friday, after coming up here and retesting resistance that was set back in the middle of December. They came down, broke above it slightly, but then had a real sell-off. I expected them to do well in the last quarter of the year, so I had picked up some shares and went overweight on this particular holding. And then as it reached these highs toward the middle of December, I started trimming some shares and actually went back underweight. So I'm waiting for a pullback to these two support lines that I have here to bring Prudential back to equal weight in my portfolio. The seasonal performance for PRU shows some weakness for the first quarter of the year. They have a book value of $91.72. There are 10 analysts that cover Prudential with an average price target of $118.60 and a range between 101 and 136. They have an RSI that dropped down into bearish territory and is nearing the 40 line. They had done a pretty good job of breaking through and moving to an overbought condition. They came back up and couldn't quite get back to that same level of RSI at these prices, and then began the sell-off. If we look at them in the weekly view, we can see that they're also below the 60 line on the RSI, and it looks like within the next week or two that we could be in a sell signal, and that would not surprise me given the weak season that they have for the first quarter of the year. We can also see that they were down 5.41% this week. This is Qualcomm, symbol QCOM. They have dropped down below this short-term upward trend line. They are trading below what I consider support at 160. If this one drops early next week, I'm going to be closing this one out because I think it will probably trend lower, especially if we have any downturn in the market over the short term. So this is one I would watch in the future and See if I can't pick it back up at a better time, but I plan to close this one out early next week. Rocket Lab, symbol RKLB, continues to perform well. They moved to a portfolio rank of 48, up from 50, and that's basically on price action. There are 13 analysts that cover Rocket Lab with an average price target of $53.23 and a wide range between $16 and $90. On the 19th of December, I noticed this cup with handle pattern, and based on that pattern, it calculated a price target of $89.49. On the 8th of January, it did hit that price target during intraday trading, but did not close above that target. And then on the 14th of this week, it did actually close above that target and is holding above it right now at $96.30. I do have a stop loss on this one at $82.47, and that's up from $73.40 last week. They are trading above an upward sloping 21-day, 50-day, and 200-day. They are in overbought condition. They still are on a buy signal and have been since about the 3rd of December in the daily view. If we move to the weekly view, we can see that they were up 13.5%. They are overbought in the weekly view, and they are still on a buy signal since about the 15th of December, and that is actually strengthening at the moment. I also see accumulation is at a 3-year high. RTX has moved outside of this 1-year trend channel. They moved to the upper side. I expect this one to pull back probably to at least the 21-day. I'm holding my shares and won't add to them until we get down to a 50-day, which they test quite often, or get down to the bottom of this trend channel. RTX is ranked 37 in my portfolio on market value. I have a blended intrinsic value of $121.84 on this one. There are 13 analysts that cover RTX with an average price target of $182.38 with a range between 144 and 227. Last week there was increased volatility on this name, basically with the administration singling out RTX in comments, along with a significant increase in the U.S. defense budget request. Things do appear to have settled out a little bit, and the price is rising at the moment. I have raised my stop loss on this one to $190, up from $185 last week. When we look at them in the 1-week chart, we can see that they rose 7.12%. They are overbought on the weekly, but we still have a buy signal on the weekly. This is a 3-year time frame. The accumulation distribution line is at a 3-year high, and the money flow is positive, which it pretty much has been since January of 2024. When we look at RTX and fast graphs, they seem to have the same concern that I do, that they have gotten very extended over their intrinsic value. To me, this is somewhat risky. I'm not adding any more to RTX, but I will add if it drops back to that trend channel that we talked about. This is United Healthcare, symbol UNH. We talked about Centene earlier. Centene has increased about 89% since their August 7th lows. where UNH has only increased about 44% since their August 1st low. This one has a ranking of 26 in my portfolio. I did reduce my position by 50% on the 31st of December last year. I have a blended intrinsic value on them of $378.97. There are 24 analysts that cover UNH with the 1-year price target of $408.08, with a range between $198 to $650. They are trading right at the 200-day moving average. The 50-day has somewhat leveled out, and they're trading just above that. So this one looks like it could be trading sideways for a while. Chart, we can also see they've been trading sideways for pretty much since the beginning of September. Their RSI is just below 50, so it's in bearish territory, and the PPO is somewhat flat. When we look at UNH in fast graphs, we can see that they do expect a little bit of growth here in 2026 and 17% in 2027 after a 41% pullback in 2025. So they're trading at their normal market multiple, but I expect them to really trade sideways for the remainder of this year unless there's any significant news that comes out in the healthcare industry. This is UPS. They rank 18th in my portfolio. I have a blended value on them of $107.44. There are 18 analysts that cover UPS with an average price target of $106.74 with a range between 75 and 147. They had reached a low on August the 1st. They traded a little higher, came back down, and once they got to the lows on the 14th of October, have done a really good job of breaking through these resistance lines. They have broken above the latest or the last resistance line at 102. They have reached my price target of $105.55. They've been trading sideways for the past week. They are trading above an upward sloping 21-day moving average, an upward sloping 50-day moving average, and the 200-day looks like it has stopped declining and may be moving up just slightly. So it looks like they may have finally broken this persistent long-term downtrend that they have been in for quite some time. They've done a good job with the RSI since reaching these lows. They did break out above previous highs, went into overbought condition, maintained that RSI pretty well at just below 60, but above 50. They moved into overbought territory once again, but this week they have moved out of overbought condition. We still have a daily buy signal on them regarding the PPO. I don't know how much more upside we have with UPS given they've reached their intrinsic value and they've had quite a run here recently. So we'll keep an eye on this one. The next point of resistance that I see is right around $117. If we look at the weekly chart, we can see that they were down about 1.06%. They didn't get into overbought condition on the weekly chart. They are still at a RSI of 66, and they have been on a buy signal on the weekly chart since the 29th of September. We had positive money flow beginning at the end of October. Finally, we'll look at the last chart in this particular review. This is another REIT, WPC, which is WP Carey. And I highlight this one basically because of the quick run we've had over the last 2 or 3 weeks. They are trading above an upward sloping 5-day, 21-day, 50-day, and 200-day moving average. So the chart is looking really solid for WPC. They rank 28th in my portfolio. 9 analysts cover WPC with an average price target of $69.22 with a range between $66.74. They are overbought on the daily RSI, and the PPO has been in a buy configuration since the 29th of December, and they are actually in bullish territory on the daily view. When we move to the weekly view, they haven't quite got into overbought territory on the weekly view, and they just got a buy signal this week in the weekly view. Money flow has been positive since the 10th of February of last year. So WPC is looking very solid. They were up 5.65% this week. I've held this one since October of 2021. If you found this video helpful, please remember to subscribe to the channel and set notifications for future videos. Be sure to press the like button to help support the channel. I wish you the best in your investment journey, and remember to trade well. Talk to you again soon.